1 year ago, we reviewed the top 5 ETF to get exposure to the Japanese market, and you really liked it. Looking back at 2024 and the continuous economic challenges such as the Japanese rate increase, the continuous weak yen and the manpower shortages, as well as all the changes made by the new US administration and the still very strong NISA retirement account, it was about time to update that list in USD and Japanese yen. If we just look at the USD-denominated one, there are over 21 different ETFs with over $37 billion under management, so the selection was not easy. If you like investing and are considering Japan as a diversifying market, or you are based in Japan and want to continue investing, this video is definitely for you. I selected the top 5 based on performance, specifically the past years, their expense ratio, and their focus on large indexes, with one exception. Let's start with the Wisdom Tree Japan Edge Equity Fund, known as DXJ. It tracks the Wisdom Tree Japan Edge Equity Index, which is exporter-focused, dividend-weighted index of Japanese stocks. And it is hedged to limit exposure to the variation in value between the USD and the Japanese yen. It has had good performances in 2024 and before, with the crazy stock market we had and the fall of the Japanese yen versus the dollars. The expense ratio is reasonable at 0.48%. Remember, those ETFs are a little bit more expensive because they are looking at outside the US market. So if you compare to US indexes, they are going to be a little bit more expensive. If you're looking at the holdings, they reflect the Japanese economy, and you recognize household names from all across the world that everybody knows. I think it's a solid choice that should continue benefiting from the interest rate delta between the Japanese yen and the US dollar in the coming year. Number 2 is the Franklin FTSE Japan Edge ETF, or FLJH. It's relatively recent ETF, just launched in 2017, and one of the smallest in terms of assets under management, or AUM. It has quite an interesting approach, completely hedged against currency fluctuation with a decent return over the past few years. It has one of the cheapest expense ratios of the list, and again, very household name that you know and that are in the holdings. Number 3 is the X-Tracker MSCI Japan Edge Equity ETF, or DBJP. That's a mouthful. It tracks the MSCI Japan US Dollar Edge Index, which represents a currency hedge approximation of the performance of the MSCI Japan Index, basically replicating an index and hedging it. So you get exposure to the equity market without the impact of currency fluctuation. It's a much smaller fund in terms of the asset under management, but still very good performance compared to its expense ratio. The sectors on the top holdings are actually quite similar to the other ones because we're talking about household name, and it has not as much focus on dividend and export. Number 4, we have the iShares Currency Edge MSCI Japan ETF, or HEWJ. Here we're tracking the iShares MSCI Japan ETF with an HEWJ. So actually we are tracking another ETF, which is a broader sister ETF as you want. The original ETF holdings are as follows. So very blue chip, very well-known name. That's for the background. This ETF itself is a bit smaller than the previous one, and it offers good performance. It just replicates it. Good expense ratio, and this holding is basically the previous ETF with a lot of cash to do the hedge between the two currencies to avoid the fluctuation. It's not too speculative here, it's just really getting an edge. And that's why it's there. It's good performance overall for this fund, and it's compared to the other one to give you some broader and some more choices. Now, number 5 is a little bit different. We're looking at the Wisdom Tree Japan Edge Small Cap Equity Fund, or DXJS. So this ETF tracks a dividend weighted index of Japan's small cap stocks. So something that usually retail investors do not think about too much, the small caps. But it's quite interesting because they usually have good return. So it is a relatively smaller ETF, smaller number of assets under management, but still quite an okay expense ratio compared to the other one. And it's had a good track record in the past 5 years, though we are getting a bit on the expensive side. To go back to the expense ratio, you may recognize some of the holdings, but many are quite domestic, so that might not be something you know except if you are really interested into Japan. It's a good diversification away from blue chips by going into those small caps if you want to have more exposure to the overall economy and what really powers the Japanese economy, which are small cap, small businesses, basically. What I did is I skipped a lot of different ETFs because they are not what I thought would be appropriate for us as long-term buy-and-hold investors. For example, I completely skipped the ProShares Ultra Short Yen YCB ETF because it's very speculative and not something I would hold personally. I also skipped the Matthews Japan Active ETF because it doesn't have a long track record, even though it has good performance, but not a track record long enough. So for us, again, long-term investors, I didn't want to go too much into that. But feel free to have a look on your own. Here you go. All the USD-denominated ETF that I selected and that I found interesting. So if you do not have any Japanese yen to invest, you can stop watching now, but not before you click the like button, and why not subscribe? That would help us a lot. Thank you so much. Now, if you're still interested to learning more, or if you have Japanese yen to invest, let's look at the top 5 Japanese yen denominated ETFs. And as we get started again, this is just my own opinion, shared for entertainment and information purpose only. This is not financial advice, and you should do your own research and talk to professionals before making any investment decision. All those ETFs are not leveraged, but you can find their leverage equivalent as well. Though the more leverage you get on the upside, you're gonna get on the downside as well. And as we are going for long-term buy and hold, I'll focus on the unleveraged ones only and based on indexes. Let's start with a TOPIX focused ETF. But first, what are the main indexes on the Japanese stock market? We had the full video about it that I'm showing you and linking down below. But let's summarize quickly. An index is a tool for measuring change in a group of representative data. Very vague, isn't it? Basically, it measures the price performance of a basket of securities using a standard metric and methodology. And you can have indexes for many different asset classes like stocks, bonds, commodities, and also industries, geographies, a whole market, or just part of a market. And there are mainly 3 big types of indexes: capitalization weighted, price weighted, and equal weighted. The TOPIX is a capitalization weighting index, and the Nikkei and the Nikkei 225 is a price weighting index. Again, link down below for the full video if you want to deep dive. Let's go back to our number 1, which is the Nikko Asset Management listed index from TOPIX. So this ETF just basically replicates the TOPIX index performance by having the same components or same holdings, if you will. The last 5 years have been really good overall in the Japanese market, but the last 1 year has not been so good, so we'll see what happened afterwards. The expense ratio is really low at 0.07%, which is usually standard in Japan. And Nikko Asset Management is a very big, very reputable asset manager, and this ETF is one of the choices to invest on the TOPIX index. You have some similar with other asset management. This is one of the main and the most standard one, if you will. Let's continue with the Nomura next from Nikkei 225. This one obviously goes and replicates the Nikkei 225 index, which is one of the biggest indexes on the Tokyo stock market. Nomura is one of the largest asset management companies in Japan, so very safe bet. It has a very low expense ratio of 0.1%, and it's a good entry point to invest on the Nikkei 225. The holdings, they reflect the index. No big surprise there. They're very large, well-known companies. For number 3, let's completely change gear and go to the Nomura Next Fund's TOPIX Steel and Non-Ferrous ETF. This ETF follows the TOPIX 17 Steel and Non-Ferrous Index and replicates its holding. So I know what you're thinking. Why should I care about these old school commodities when the tech sector is on fire? Good question. Because you're probably already super invested in the tech sector like I am, and actually steel and non-ferrous metals are essential to build all the tech gadgets and the data centers and the house and the cars and everything, the overall economy. They benefit from every possible positive economic cycle. And even if the expense ratio is a bit high at 0.352%, the performances in the past 5 years are really, really good. So I think it offers a nice way to diversify your investment to the rest of the economy while having very good return and better return actually in the past year compared to TOPIX or the Nikkei 225. And going to the next one is the same line of thought. We're going at the Nomura next fund TOPIX 17 banks. So that's another Nomura fund because they have many. It's a more selective with the top 17 financial institution, replicating the TOPIX 17 bank index. great return without any surprise here, given the current economic situation, the increase in the interest rate, and the size of the financial sector in Japan. Expense ratio is still a bit on the expensive side at 0.352%, but still okay given the performance. And you can see the holdings, really major names you've probably heard about, all those banks, even if you're not based in Japan. So here we are at the number 5 and last on our list, the Nomura Next Funds TOPIX Energy Resources. Again, an ETF that looks at one of the TOPIX sub-indexes. And here we are concentrating on the energy sectors. That's a very exciting sector with its ups and downs around gas and oil and all the problem, all the differences, I should say, between the yen and the US dollars. And it has had one of the best returns of the last year and the last few years. And it's also quite important to look at it because Japan imports the majority of its resources, right? So it's probably one of those most volatile that you can look at it for the reason I just mentioned, but it's also one that brings you some of the best return. It's still expensive at 0.352%, but it's quite good and it goes into distribution and exploration as well. And that's it for the top 5 Japanese yen denominated ETFs for this time around. As you saw, the returns were quite good, except maybe for the main indexes in the past year. If you prefer to limit yourself to the general indexes, so Nikkei, TOPIX, 225, maybe 400, I'm linking a list in English down below so you can have a look at your own pace whenever that's convenient. The Japanese stock market still offers interesting options for international diversification with the same risk and rewards at other places. Though its unique export-focused economy and large corporation could help diversify and reinforce a fund-focused long-term buy and hold portfolio. Let me know in the comments down below if you are a Japan-focused investor. If you enjoyed this video or learned something, please give it a like and don't hesitate to subscribe if you haven't done it already. If you are interested in learning more about Japan and personal finance, be sure to check these videos. Thank you again for watching and until next time, goodbye.